In this video, we're going to talk about Ideanomics. If you're considering buying its shares in your portfolio, then please keep watching this video until the end, because it'll cover many factors that should be considered regarding buying, holding, or selling the shares. During the most recent trading session, the stock opened at $2.96 and closed at $2.86. The lowest point at which it fell to was $2.84, and the highest point it rose to was $2.98. Compared to the current price action, its week low was 55 cents, and the 52-week high has been $5.53. The current trading volume of Ideanomics is 16.4 million shares, compared to the average volume of 21.2 million shares. That current volume of Ideanomics suggests that the market wants to take a few steps back and re-examine its exposure to the company, which is currently recovering from the recent sell-off pressure. Because the recovery happens within a general market sentiment that remains mostly bearish, it explains the decrease in volume. Another possible sign is that investors may be now shifting away from companies like Ideanomics altogether, because they've been popular for a period of time that was deeply unstable across the board. Now that things may be returning to normal, it is possible that some of the market capital wants to move on from Ideanomics altogether. Of course, that remains a theory for the time being, and we need to wait for the market data to confirm whether the market is putting their faith in the hands of Ideanomics or if they're really moving on. Ideanomics has an interesting price trend for both the short and long term, mostly because the company has been able to remain relevant within the current trend of the market, or in other words, to stay in the loop of what is popular and fashionable with investors. With that being said, just like many other companies, it has a hard time to resist the negative market sentiment and has lost a significant portion of its value back in early 2021. We can see that despite the fact that the company has purchased many startups in EV and renewable energies over the past year, investors were only able to reward it for a time before the company stock began to trade either sideways or only slightly upward. This means that the market priced in the company's current potentials and wants to see where the company is heading towards in order to be competitive. My recommendation for the stock is to start buying now, but to keep at least 90% of your allocation for later, because the current price point is considered to be high from a 5 years perspective. In my opinion, the stock may go through other waves of corrections and pullbacks in the future, and the actual floor based on the market data is between $1 and $1.50. So it would be recommended, in my opinion, to adjust your position or buying pattern to consider this possibility. From the price actions patterns, it would be up to you to determine if the market has enough steam to go upward. My opinion is that it does, but slightly so. Now, let's take a look at the enterprise value of the company, which represents how much the company's assets are worth once the debt is removed. The enterprise value of Ideanomics differs a little bit compared to the market capitalization, since it has less speculation included in the price. From a value of $371 million about a year ago, its value now is $978 million. The increase is significant, but not as flamboyant as some other companies we have covered so far, for which the company's value sometimes jumped by more than 1,000% over a period of just a few months. Another outside signal to observe is the total number of shares outstanding. Generally speaking, if the number of shares keeps increasing, then it suggests that a company is selling its own equity to pay its bills. The quantity of common shares outstanding did have a significant increase in late 2020 and has since then remained stable at 426.9 million shares. For a company like Ideanomics, there is a real risk of shareholder dilution, at least for the short to medium term, because the company doesn't generate enough cash flows to cover its spendings and may need to raise more capital to finance future acquisitions. Meanwhile, the financial market's overall sentiment is still relatively reluctant at putting more money in the same genre of company. Following the stock market craze back in 2020, the stock market decided to pull back massively from the entire disruptive and innovative stocks, covering biotech, electric vehicles, and anything requiring keynote presentations to attract capital. This wave of pullback can be explained in two ways. The market needed at one point to park their capital in some niches to avoid losses, and since the stock price of those niches increased multifold, many of them decided to cash in their chips and didn't mind the massive sell-offs it could initiate. The second reason is because the market began to realize how overly exposed investors have become to the growth stocks. These are the reasons why the stock ultimately collapsed for so many companies that everyone was talking about. In the current circumstances, the recommended approach is to be careful when buying the stocks. On one hand, the stock may be able to climb back on its own when the operations begin to carry the stock price. On the other, it may simply rise because it fell low enough. This means that in the current market settings, we need to tread water carefully regarding buying stocks. Many of them have become overpriced over the past 12 months, and we may need to wait for another few weeks or month before the timing is ripe to increase holdings. With that being said, there will always be sudden events that will create a lot of volatility for individual companies. In the case of Ideanomics, it's probably going to be other acquisitions. So this is why it's always recommended to hold a small position on stocks like those in case you fear missing out. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.